there. Yes, as David mentioned, for our next keynote will be Anaelle Ubaldino, head of quant advisory at Koris International, and she'll be talking about timing the low volatility factor. Over to you, Anaelle.
Good morning. Hi. Thanks. So good morning, everyone. I hope by now you can see the presentation on the screen. Yes, perfect. So as Tom just introduced me, my name is Anaelle Ubaldino. I am the head of quantitative advisory at Koris International, and I've been invited to talk about timing the low volatility factor. First, I'd like to a few words about who we are. So Koris International is a financial investment advisory firm. We've been focusing on quantitative investing, designing systematic, rule-based, risk-based investment strategies. And recently, we've been bought by TrackInsight, which is a free online platform for ETF data and analytics. And I've been in charge of the business unit called Expertise within TrackInsight. So today, I'd like to start by a brief introduction on the low volatility factor before going on as to why we think it makes sense to time this factor. And I'll present a tactical model we developed for factor tilts, talk about how it works, how it performed in the past with track record, where it stands now, looking at an outlook, and of course, I'll also discuss the challenges that stand in the way of a successful implementation of these kind of strategies. So starting with the what and why of the low volatility factor. The low volatility factor is composed of low volatility stocks. It's pretty straightforward. These are the stocks that have a lower volatility than their peers. And the academics have highlighted that these stocks are a way for investors to control their risk while generating superior investment returns over the long run. And when we think about it, that's quite counterintuitive because that means lower volatility stocks would generate higher returns. This is not what we've been taught, right? We've been taught that if you want higher returns, you should have a higher volatility. Risk and return go hand in hand. So this low volatility factor is an anomaly, and there have been a few explanations as to why it might exist. So among the many theories, we find that this unusual premium might stem from two things: the investors' behavioral biases, as well as the structural constraints of the fund industry. So investors might be biased to consider higher volatility stocks more than low volatility stocks in what we call the lottery effect. They might consider the investment as a bet, and so they might want to increase the volatility of the stocks that they'll consider. As for the asset management industry, funds sometimes have strict leverage constraints, and so the managers will also want to focus on higher beta stocks in order to optimize the replication or outperformance of their respective benchmarks. Which brings us to why we think it makes sense to time the low volatility factor. There is a premium associated to low volatility stocks over the long run. However, this factor, as well as other factors, it shows cyclicality in these returns. And for low volatility, the periods of outperformance will be bear markets. So during market downturns, as you can see on the graph shown here, displays the return of the broad market index, which is S&P 500 in this example, and low volatility factor in light blue. As you can see, the low volatility factor is outperforming the market during these periods of time. So these are the 5 biggest market downturns in the last 15 years. And so once we've said that, what it means is that if we want to time that low volatility factor, we must be able to anticipate the periods in which it will outperform, that is, deteriorating market conditions. So at Koris, we have developed a tactical model for factors. The original model we have developed, and that is actually in production within a fund that we advise, is revolving around 4 factors, but the process is the same for all. So today I'll be focusing only on the low volatility part of the model. The process starts with defining explanatory variables. These are statistically significant variables that explain the probability of the factor outperforming in the future period. They can be macro variables, market or factor related. And what we do is at each point in time, we evaluate the signals we get from these variables. That means we retrieve their value and we determine where they stand with regards to their long-term mean. This gives us a signal that is either a go or a no-go signal, as represented here with green and red toggles. And in order to assess the signal, we rebase everything out of 100% because the number of variables might change for each factors in our model. So in order to make everything comparable, we rebase everything out of 100% in what we call the signal intensity. So in this example, 2 out of 3 go signals would result in a 67%, so 2/3 signal intensity. 0% meaning don't go on the factor, 100% go to the factor. So for the low volatility factor in specific, 100% reading on that signal intensity is actually a pretty depicting a pretty bleak picture for the broader market, because it means a downturn is probably expected. So this is how it works. And I've been asked to present a track record of our model. So this is not a back test. It's a real track record. Of course, we've back tested that model, and it's been, I mean, the back test is only good as you want it to be. Obviously, it was good enough for us to start producing advice on a fund using this model. And now this is the 2 last years showing the behavior of our model with only a focus on low volatility factor. So here on the graph, in the background, you see the low volatility signal intensity. It's an area, it ranges from 0% to 100%. And on top, I've printed the cumulative return of S&P 500, so the market returns. It's interesting to see how they evolve. So if we look at the downturn of the last quarter of 2018 first, what we can see here is that the readings of our signal was hiking up step by step. And so it went from a very conservative signal to, I mean, it inched up even before the first real downturn of the market, and that's the behavior we want to see. As you can see, the behavior is quite gradual. It is not oscillating between 0% and 100% on a daily basis, which is exactly what we want to see, because then we can make sense of the readings. Going to the second big downturn over the past 2 years has been the start of 2020. Here we see the same behavior from our model with low volatility signal intensity going from 0 to 100%, but this time over the course of a few weeks, whereas it took a few months in 2018. Another interesting insight we can get from this graph is that more recently, in the last few weeks, the readings for low volatility have been going up, which means that we might expect some market volatility spike in the months to come. So this was the track record. Now where we stand today. As I was saying, in early September, our signal for low volatility factor turned from red to green. And that's not really good for the market because it means there is probably a volatility spike ahead of us. And in terms of performance of the low volatility factor, you can see on this graph, it displays the excess return of the low volatility factor in excess of the broader market for S&P 500. And the red, there are two periods in this graph, red and green. The red would be when our signal is no-go and green go on low volatility factor. And the model signal has shifted at the correct moment in time and identified that reversal in the factor return. Before ending this presentation, I want to insist on the challenges of factor investing because they exist, especially the fact that when you want to implement this kind of strategies, you will have to choose an index, a factor index, or any other tool to implement the signals you get from the model. And different factor construction methodologies can result in quite different returns. And if you look at the graph on the left of the screen, it's actually extracted from a paper we wrote last year. And what it shows is that over the same US large cap stocks universe, different expressions of the same factors have quite significant difference in returns. So if you look at the blue dots, there are low volatility factor indices. So 4 well-known low volatility factor indices actually have an annualized return difference of 3%, slightly over 3% between the best performing and the worst performing factor index. And that's over the past 20 years, so it's quite significant. Another thing that is interesting to take into account there, and that adds to this, is the specifics of today's current market, especially with the S&P 500 in the situation where the largest 5 stocks are driving all of the gains. And so that adds to these challenges, depending on each factor construction methodology, whether you include or exclude these 5 stocks, or how you decide to weight these 5 stocks, it can have a significant impact on the results of the strategy implementation. So that's it for me today. Here are my key takeaways. Low volatility is a factor that has a premium over the long run, demonstrated by the academia, is well known. It also has a defensive behavior during market stress where the premium expresses more. So that's why we present a model that is a tactical tilt to this factor and is identifying the periods of expected factor of performance that is deteriorating market conditions. And I wanted to insist on the last point is the devil is in the details, and we should really pay a lot of attention to the specific methodologies of the tools we're going to use to implement these strategies, whether factor indices or funds, ETFs, as they can significantly impact the success of your investment strategy. Well, that's it for me. Thanks for your attention. I'm ready to take a few questions from the audience.
Great stuff, Anaelle. Yeah, so we've had a couple of questions come through. One was, how would you explain the many false positives the model generated in the bull markets over the past months and in 2019?
Yes, that's a great question, actually. So the signal is not designed to predict downturns, but periods of higher volatility. As we know, downturns are periods of higher volatility, but the recent markets we've seen have also quite a huge rebound following these downturns, where volatility is also high. And so that is why the model is interesting in the sense that it predicts these periods of higher volatility, and they can start with a downturn, and then they will drag on with the rebound and stays a period of high volatility. So the model does not identify that as correctly as the first step. Yeah.
That's interesting. And another question we had was, have you combined your low vol model with ESG tilted funds? And if so,
Yes.
what has the findings been?
It's very interesting. Actually, so I've talked about the fact that this tactical model is actually implemented today within a fund. I'm not going to say the name because I'm not here to promote it, but this fund, no, it's true, but this fund is ESG filtered. So the partner with which we implement it provides us with an SRI filter. So we remove, I think, around 25% of the S&P 500 universe based on a best-in-class approach. And it has an impact on the returns. As I was saying, the largest 5 stocks are driving the returns, and the largest 5 stocks are not all ESG approved in this methodology. So some of them are excluded, and it weighs in the returns of the strategy.
Good stuff. And I think we've just had one more come in, which is, does low vol timing have a high correlation with value timing strategies?
That's a good question. So today I was focusing only on the low volatility factor. In our model, we actually implement 3 other factors, of which value. And we assess the signals we get depending on their intensity. So the fact that we rebase everything to 100% is actually helping us to determine which factor has the strongest reading at a point in time. And if both have a high reading at the same point in time, then it will be split equally depending on the relative weight to the other factors. So to answer, I don't think that they have a correlation. However, this would be taken into account by the model depending on the signal intensity.
Great stuff, Anna. Well, those are all the questions we had. Thank you for jumping on. That was really interesting stuff. Very much appreciated for a bit of your time there.
Thanks for inviting me.
No problem.